The last section of material we have here is amortization. And amortization is just the cost recovery for intangible assets. An intangible asset can fall into one of four categories. It can be a Section 197 purchased intangible, an organizational expenditure or startup cost, and then 3 and 4 are research and experimentation costs and patents and copyrights. We are not going to cover 3 and 4, so we're focusing our attention on Section 197 purchased intangibles and organizational expenditures and startup costs. So 197 intangibles occur when a business acquires the assets of another business for a single purchase price. These have to be purchased intangibles. So that distinction is important because if I have internally generated goodwill, so if I have internally generated goodwill, meaning my business is worth more than the sum of all of the assets because I have a good reputation or something like that, or I have a patent or a copyright that I generated. We have different rules for that. This does not include internally generated. These are all purchased intangibles. All right, some examples of these are intangible assets such as customer lists, patents, trademarks, goodwill, going concern value, covenants not to compete, etc. I know that we have patents and copyrights listed up here, but those are internally generated. These are all purchased. So I purchase another company, and that other company has customer lists that are valuable, patents and trademarks and goodwill that is valuable. I amortize them over 180 months or 15 years, regardless of their useful life. And regardless of their useful life is really important because you'll see examples where there's a patent that expires in 5 years. And our tendency is to say, okay, I should amortize that patent over 5 years of its remaining life. No, you amortize over 180 months or 15 years. Okay, so you'll see these problems where there's this trick where it's telling you there's a patent that expires soon, and you're probably thinking in a financial accounting mode where you're looking at what is the economic reality of what's happening and thinking, okay, I should do an amortization over 5 years. No, when we have these purchased intangibles, we amortize them over 180 months regardless of the useful life. All right, we use a full month convention. So you receive a full month's worth of amortization regardless of what day the business was purchased or sold. So if you purchased the business on January 20th, you would get the full month of January and you would amortize over all 12 months of the year because you will have been deemed to have held that asset for 12 months. All right, let's talk about then organizational expenditures and startup costs. So first, let's define organizational expenditures. These are expenditures to form or organize a business. The types of things we're looking at are state fees and licenses, accounting service to start the organization, document drafting, and other legal services. Okay, so think about those sort of legal type things that you have to do to start a business. I want to add that you do not include costs to sell stock. So you're going to have to pay stock initiation fees and things like that. Don't include those in organizational expenditures. They don't count. These types of expenses are generally incurred prior to starting the business, or before the end of the first year of business. All right, so we'll see an example of what these are, but think about things like getting your business approved to operate in the state of California, or organizational meetings. Accounting is a good one. Legal is another really common one you see here. Those are deemed to be organizational expenditures. And then the common trick is the cost to sell stock. So if your business is going public and you're going to sell stock, or you're organizing as a corporation and you're going to have an IPO, those costs that are associated with the sale of stock do not get included in organizational expenditures. All right, then we have startup costs. These are very similar to organizational expenditures. They're incurred to investigate the acquisition of a trade or business. So I want you thinking of things like going and trying to assess the marketability of a business. So I'm going to say advertising, employee training, the investigation costs. So if you're doing a market analysis, something like that would be the startup cost. All right, the cost of investigating a new business for a new business are deductible only if the taxpayer enters the business. If the taxpayer is expanding an existing business, these expenses are deductible regardless of whether or not the business expands. So that's an important distinction. We have different rules for a new business. They're deductible only if the taxpayer goes through with it. But if you're thinking about expanding your existing business, they're deductible even if you decide not to expand. All right, for organizational expenditures and startup costs, these are the rules. You can deduct up to $5,000 immediately for both organizational and startup costs, for a total possible deduction of $10,000. And that's $5,000 for the org and $5,000 for the startup. This amount is reduced dollar for dollar for all of the expenditures that exceed $50,000, and they're calculated separately. But let me just give you an example. If you had $51,000 in organizational expenditures, you're $1,000 over that 50. You would not be able to deduct the full $5,000 right now. You would have to reduce it to $4,000 and then amortize the rest. So when it says that you can deduct up to $5,000 immediately, they're just letting you recover some of that cost quickly. You're going to amortize the remaining amount, whatever you didn't get to immediately amortize, over time, but we would rather get the cost recovery faster. And whatever's left, we amortize over the remaining 180 months. All right, so let's see what this looks like. We have Sarah's Dog Wash began operations on August 1st, 2019. Between June 1st and July 15th, Sarah's Dog Wash incurred the following expenses. She has legal fees for a corporate charter, $38,000. Accounting fees to create a ledger system, $15,000. Then we have employee training costs, $3,500, and traffic pattern analysis, $4,000. So as we've read through this problem, I separated out the organizational expenditures in yellow and the startup costs I did in orange. So the organizational expenditures, we had the legal fees, $38,000, and the accounting, $15,000. So our total organizational expenditures are $53,000. We can see that we're $3,000 over the $50,000 threshold. So you lose $3,000 of your immediate $5,000 deduction. You can only deduct $2,000 now immediately. All right, so I'm going to say here's my $2,000 that I'm deducting immediately. That leaves me $51,000 that I'm going to recover over time. Shoot. So I'm going to multiply this. There are a couple different ways you can do it. You can divide it by 180 months, and you can get a monthly amortization. Or I'm going to multiply it in this case by 5 over 180, because our business began in August. So I will get August, September, October, November, and December, 5 months of amortization this year. And this will give me the amount. So I will get $1,416.67. And that's the amortized portion that I get this year. In total, my cost recovery for this year is $2,000 that I got immediately, plus the amortized portion, $1,416.67, for a total of $3,416.67. All right, if I come over here and look at the startup costs, the rules are really the same, but we look at them separately. So I had training of $3,500, and I had the traffic analysis that was $4,000. $7,500 in total startup costs. Because I'm below the $50,000 threshold, I get to deduct $5,000 immediately. The $5,000 doesn't get reduced by anything because my total is under $50,000. That's a 7 there. So I have $2,500 remaining. I amortize that over 180 months. I'm going to do the same strategy I did before. Because my business starts on August 1st, I get 5 months of amortization this year. So 5 over 180 is $69.44, and that's the amortization portion. My total cost recovery for my startup costs is $5,000 plus the $69.44 for a total of $5,069.44. So I look at these expenses separately, organizational expenditures and startup costs. Remember, my organizational expenditures are things like accounting, licenses, legal, things like that. My startup costs are more the employee training, the investigation costs, so that traffic pattern analysis that we saw a minute ago, that was considered a startup cost. And the rules say that we can deduct $5,000 immediately each for organizational and startup costs for a total possible deduction of 10. But the amount that you get to deduct immediately is reduced dollar for dollar when your expenditures exceed $50,000. We look at organizational and startup separately. So in our example, our organizational expenditures exceeded $50,000 by $3,000. So our immediate deduction of $5,000 was reduced by 3 for an immediate deduction of only 2. That left $51,000 remaining to be recovered, and that's over 180 months. We got 5 months this year because we started our business August 1st, and so we would get August, September, October, November, and December in amortization. The total cost recovery here, $3,416. Startup costs only totaled $7,500. They did not exceed the $50,000 threshold, so I could deduct $5,000 immediately. That left only $2,500 to be amortized over 180 months. I got 5 months this year. I add up my cost recovery that was the immediate deduction, the amortized portion, for my total cost recovery of $5,069.44.